Hello, and thank you for tuning in to the quarterly market update hosted by the Investment Committee here at Curo Private Wealth. I am Atrisa Roberts, COO and partner, and I'm joined by my partner, Ann McCabe, also CEO here at Curo, along with advisor Drew Culver, advisor Manny Carranza, and our investment and planning associate, Xander Cochran. So we will begin this update as we do with everyone, and that is with a review of where we are so far since the beginning of the year. So since the start of the year, tariffs have been a focus of the Trump administration's policy agenda. And while there is still uncertainty around trade policy, tariffs have risen now at their highest levels since 1930 and are expected to continue rising. Consumer sentiment or consumer confidence has significantly declined, and we have seen higher market volatility due to policy uncertainty around the tariffs, along with some concerns around the budget and some recession fears. The good news is that while US stocks are down, we have seen diversification working again as fixed income, international, and certain equity sectors have helped navigate some of the volatility. Now, as a review of our asset classes returns from the beginning of the year, and this data is through the 9th of April, we have seen in a reversal of the last couple years, the Magnificent Seven stocks, which include Tesla, Amazon, Meta, NVIDIA, Microsoft, Apple, and Google, see the biggest pullbacks year to date, down over 18%. Fixed income and commodities had mostly flat to slightly positive returns, with US real estate down over 6% through the first week of April. If we drill into the actual sectors of the US equity markets, there has also been a rotation in sector performance. Sectors like consumer staples, healthcare, and utilities, which have had more moderate rallies since the market low of October 2022, are now outperforming communication services, information technology, and the consumer discretionary sectors since the beginning of January through the first week of April. And those have been sectors that really rallied really well from the market lows of 2022. So now my colleague Drew will review some historical market data.
Thanks, Atrisa. So over in the next few slides, we'll really be looking at some historical volatility and the importance of staying invested throughout it. So looking at the gray bars, this is the calendar year returns for the S&P 500 dating back to 1980. And those red dots are the intra-year declines that we saw each year. So even though you do see a lot of red littered throughout, it's very common, of course, to see these 10% corrections in the market. Very normal, but again, it's important to stay invested through it, especially if you look at a year like 2020, where we saw a pullback of over 34%. The market still ended up quite positive for the year at over 16%. So on average, we do see those entry year drops of about 14.1%. However, returns were still positive in 34 of those 45 years. And this shows right here, if you invested $10,000 back in 1980, how much it would have grown to by the end of last year. So if you had that 10,000 invested all the way throughout that time period, then your portfolio would be worth 1.7 million. However, if you miss even just the best 5 days that the market saw throughout that time frame, your portfolio would only be at just over 1 million. So nearly a $700,000 swings just by missing the 5 best days. And looking to the far right at the extreme of missing the 50 best days, that 10,000 would have only grown to 120,000 versus 1.7. And it's really important to remember that very often we see those best days right after we see the worst days. And right here is looking at the historical bulls and bears that we've seen in the market dating all the way back to 1942. So a bull market is when we've seen the market hit a 20% growth, and a bear is a 20% down from that previous high. So you can see certainly the length and the intensity of the bull markets certainly outpaces those yellow bear markets. So the average bull market lasts 4.3 years with a return of 150%, whereas a bear market only lasts just about 11 months with a loss of 31.7. So certainly bear markets feel very long when you're in them, but those bulls really are outlast them and are a lot more intense. So really important to stay invested through those so that we get to the bull markets. And so on that note, I'll hand it over to my colleague Manny.
Thanks, Drew. So this chart looks at the relative valuation of the 10 largest companies in the S&P 500 compared to the other 490 companies within the same index, going back 30 years. The key metric we're looking at here is the next 12-month price to earnings, or PE ratio. Think of this as a way to gauge how much investors are currently willing to pay for each dollar of expected future earnings of a company. Now, focusing on the chart, the teal line represents the average PE ratio of those top 10 largest stocks, while the gray line shows the average PE ratio of the remaining 490 stocks. What immediately jumps out is that in the late 90s, which is the dot-com era, and more recently after 2020, the teal line takes off compared to the gray line. So zooming in on the current market, what stands out is that even after experiencing a 5 times turn derating in the first quarter of 2025, in other words, the average PE ratio dropped by 5 points, the largest stocks are still trading at a significant premium. So even though their valuations came down, investors are still paying considerably more for their expected future earnings compared to historical levels. Secondly, the chart shows that the other 490 companies in the S&P 500 continue to trade at a more reasonable valuation closer to their historical averages. In summary, the largest companies remain relatively expensive when you compare them to the rest of the market, and this is in line with our investment committee's actions in the last few months of reducing our exposure to the cap-weighted S&P 500 in favor of the equal-weighted option. So on our next slide here, this shows us a comparative view of how value stocks perform against growth stocks based on the starting price to earnings differential since 1995. So the price to earnings differential is a difference in price to earnings ratios between these two types of stocks. So on the graph, you'll see that the stocks are divided into 5 groups or quintiles based on this differential. So looking at the far right, you'll see that when the difference in valuation between value and growth stocks is the largest, value stocks have outperformed growth stocks 100% of the time since 1995. The data reveals that when value stocks are seen as being their cheapest, they're averaging annualized outperformance of 11.3% compared to growth stocks. On the other hand, growth stocks have slightly outperformed value stocks when the PE differential favors growth. As of the first quarter of this year, value stocks are in that 5th quintile, suggesting a favorable period of value-oriented investments. So on our next slide, we'll just go over some of the changes we've been making recently in our portfolios. So one thing that we did was we reduced the stock exposure from a 2% overweight to a neutral allocation. And this reduction came from both large and small cap US stocks. And small cap US stocks, we reduced that exposure because we're expecting them to be more vulnerable in a potential recession situation. The 2% increase to bonds was allocated to short-term, high-quality corporate bonds, and in our tax-aware model to core municipal bonds. We also increased our international stock exposure to neutral. So we sold our position in the Pacer Cash Cows ETF following the change in the fund's long-term strategy and a period of underperformance. And then we added to both US and international large cap value stock with the proceeds to remain overweight to value while increasing international stock exposure to neutral. So next, Xander will give us an update on the economy.
So this is our economic dashboard that we like to share every quarter. And what you may find surprising is that there's actually very little change compared to the end of last year, despite everything that's been going on in markets and the economy in the past quarter. So this shows 5 different aspects of the economy from a positive to negative territory. So starting off with monetary policy is really around what the Federal Reserve Bank is doing with interest rates. They've been in a holding pattern of late, really putting in a hard spot right now, because if inflation is moving higher, that would cause them to increase interest rates. But if the economy moves towards recession, that would warrant them decreasing interest rates. So right now they're kind of stuck between the two. For manufacturing, we saw this move a little bit lower in the past quarter towards the negative territory. We did see a little bit of a increase at the beginning of the year, but that's since come down a little bit. Next, we see the consumer, which is an interesting story. Overall, we see the consumer still pretty healthy with overall good balance sheets, although delinquencies have moved up. But the real shift here has been that consumer confidence or sentiment, as Teresa mentioned earlier, has come down considerably. Next, we have the housing market. This hasn't really changed in quite some time, really, with interest rates for mortgages being much higher, which has really slowed down the housing part of the market right now. And then lastly, we have the labor market, which, although it may feel like it's a little bit harder, challenging time right now, especially with some of the announcements with the DOGE cuts or the federal workforce being downshifted, we have seen this remain relatively stable, although unemployment has ticked up slightly. If you see the next slide here is looking back over the past year on a month-to-month basis, we have seen job growth continue overall. And this dotted line here is the rolling 6-month average. And this number has remained relatively stable over the past few months looking back. Now, of course, this is one area of the economy that we need to watch very closely as a good predictor if there's trouble here that we could see a recession in the future. Because if people start losing their jobs, they don't have income, they have less ability to spend, and that, of course, affects the economy's growth. In the next slide we see here, this is labeled "Actions Speak Louder Than Words." And so in the gray line here, we see consumer sentiment. And as mentioned before, it's definitely been down over the past couple months. And with the preliminary April data, it's looking to come in just over 50, which is the lowest we've seen since mid-2022, which is when inflation was at its highest point at over 9%. So right now, consumers are definitely not feeling great about the economy, but that doesn't mean that they're not spending. So if you look at the teal line, it shows consumption or consumer spending, which is adjusted for inflation. We saw a huge dip in early 2022, but over the past couple of years, we've seen it back on trend. And despite a small blip at the beginning of this year, it really shows that it's continuing to grow. Next, we see here, part of the reason of why consumers are more cautious right now is because concern around inflation, and inflation reigniting again due to tariffs this time. And so we see this blue line here, which is expectations over the next year, has definitely moved higher, although not as high as what we saw in 2022. But the grayish line is expectations over a 5-year period. And this is actually at the highest level that we've seen over the past 2 decades. So it's definitely shifting some of the behavior around going out and buying for consumers. We've seen some recent change in terms of people going out and making bigger purchases, like buying a car ahead of the tariffs, kind of front running that. And then that brings us to the last topic on the economy, which is the elephant in the room, tariffs. We see here a historical picture Right now, we've seen multiple announcements on tariffs, and it does seem to be changing almost daily of what's going on. But as of right now, we see an estimate for tariffs going back to almost the level that we saw peak in the early 1930s. This is when there was the Smoot-Hawley tariffs going on during the Great Depression. And so we see this at the highest level. Of course, this could change over time if there's negotiation with different countries, or as things proceed, it definitely could be lowered. But the large impact on the economy is still uncertain, as depending on how high tariffs remain and for how long. And with that, I'll switch it over to Anne to zoom out for the long picture.
Thank you, Xander. On that positive note, we'll try to turn things around a little bit and zoom out as we like to do. So far during this presentation, we have been focused on the first quarter and the very short-term movements and actions that we've seen in the markets and the economy. In this chart, we are zooming out quite a bit, all the way back to 1970. And what we are showing is if you would have invested $10,000 in the S&P 500 back in 1970, despite all of these events that occurred both domestically as well as internationally and crises, if you had an Austin Powers moment and you were frozen for 55 or so years and you just woke up, your $10,000 investment would have grown to almost $3 million over that time period, despite many pullbacks in the market and despite many negative events. And the average annual total return for the S&P over this time period that we're looking at has been about 11% per year. So we show this to remind everyone that we realize that the current environment is uncertain and that we have seen an increase in volatility, but we do believe, just like we've been able to get through past negative and scary experiences, that this too shall pass, and we will also get through this one as well. And as we've talked about so far, just the importance of staying invested if you are a long-term investor, despite the short-term volatility. And then we always love to finish out our presentations with a visual reminder of our philosophy here at Curo and how we love to work with clients, which is where these two concentric circles come together, what matters in your life and what we can control. We really try to live where these two circles come together, and we try to remind clients, and certainly right now, the things that we can't control, the things that are outside of our sphere of control. We don't believe we can time the markets. We don't believe we can control volatility, and we certainly can't control what Congress and the government decides to do from a policy, tax, regulatory change perspective. But what we can control is having and working a financial plan, the mix of stocks and bonds we have in our portfolio, and trying really hard to maintain our emotional centeredness when things are going crazy around us, which is very much the current environment. So we are here for all of you. We appreciate you tuning in today. And just a reminder, if you have any questions for us, please feel free to reach out. And also please connect with us on social media. Due to some compliance constraints, sometimes we're actually able to post information on social media more quickly than we are able to get out via email. So please make sure you connect with us on all the social media channels and reach out if you have any questions. Thank you so much for taking the time to watch this. We hope it was informative and interesting, and we will see you next quarter for another update.